Welcome back to Season 9 of Talking with Traders. We're into the 5th year of this podcast that began in 2020. Once again, IG have come on board as the sponsor of the podcast. We're truly grateful to have such a global leader in online trading as our sponsors. In the coming weeks, I'll be interviewing various guests from around the globe on the topic of trading. Some of these will be past guests that we invite back onto the show, and some will be new guests. The idea is to attract a broad spectrum of different perspectives from various players in different areas of the market. None of what you hear here is financial advice, but it is intended to get you thinking about how you might be able to apply what you hear here to your own trading and investing. Remember to subscribe to this podcast on your favorite podcast app. That way, you'll be notified when new episodes are released. Or if you watch these interviews on YouTube, please subscribe to our YouTube channel and give us a thumbs up and leave a comment if you wish. We welcome the engagement. Once again, thank you to IG for sponsoring this podcast into its 5th year, and thank you listeners for your continued support. Now, let's get on to this week's interview. Welcome to another episode of Talking with Traders, and this week it is my great pleasure to welcome Tom Basso to the podcast. He's no stranger in the world of trading. He was the founder of TrendStat, managed $600 million there at one stage. Also featured in Jack Schwager's second book, New Market Wizards. So this will be our first bona fide market wizard on this podcast, which I'm very, very proud of. Founder of EnjoyTheRide.world. Author of 3 books, the most recent of which I've just finished listening to on Audible, called The All-Weather Trader. Tom Basso, welcome to Talking with Traders. It's such a pleasure to speak to you.
It's a pleasure for me, Garth. First time.
Thank you very much. And thank you for being so generous with your time and giving us what I think is going to be an hour or so of excellent conversation today. I know before we get into all of the scheduled questioning and the conversation that we're going to have, that you are currently nursing an injured leg, and it's due to the the very active lifestyle that you lead as a retired guy.
I don't know if I can lift it up.
Oh, there we go. We can see it on the video. It's in a moon boot. What happened, Tom?
For a 72-year-old retired trader, I lead a pretty active lifestyle. So we went out fly fishing on a beautiful mountain lake up in the mountains here, just northeast of the Scottsdale area. And it's a kick boat. So you're sort of doing, you're putting your fly fishing gear on. You have waders, but then you have a flipper like a scuba diver would have. And by kicking with your flippers, you motor the boat to the behind you.
Right.
So that was one thing. 4 hours of that strained all the tendons in my knee, both knees. So I was a little stiff after that. And then I moved down for the winter to the Scottsdale area, and immediately around October 1st, we get into planting season. So I'm an avid landscaper. I spend a lot more time, hopefully in a day, usually going out around my gardens and tweaking things and planting things and all that, as I'm up and down on my knees. Well, when you 205 pounds or about 94 kilograms, whatever country you're in, and you're on your knees and then you have to go get up, you're lifting that weight up into the air. The tendons in your knees get worked a lot. That wasn't helpful. And then my wife loves to go travel. So we're going to Portugal to see Lawrence Bensdorp, actually, who's somebody you should interview if you haven't.
Right.
And Lawrence is let's see, he would be just a little bit outside of Lisbon.
Mm.
Lisbon is extremely hilly, a lot more than anybody would imagine.
Yeah, I was there last year, I know.
Cobblestones and it's ancient stairways. And I'm dealing with heavy luggage. I got my computers on my backpack, and I'm trying to help my wife with her luggage and my luggage at the same time. And we're, bouncing it over cobblestones. And somewhere along the way, after I made the trip over there, my right leg just started not being happy with me. And then you get into all these small things. They have tuk-tuk tours, which are little they have a single steering wheel in the front and they have two wheels in the back, and this driver drives you around in this electric vehicle, and it can get into some small spaces. So it's a fun tour, but the rooms in those things for a 6'3" guy, I'm bending my leg against myself and the blood is shutting off in there. Bottom line, somehow along the way, I don't know specifically any one thing did it, but the overuse has got a blood vessel or something broken behind my knee and it's swelling my right knee. So I have a appointment next Tuesday to deal with that.
Oh
Try to
dear.
figure
Well,
out.
wish you a very
But in the
speedy
meanwhile,
recovery.
I walk around in a boot and I
Yeah.
try to elevate it as much as I can.
Well, I wish you a speedy recovery because I know you're a very active guy,
Yeah.
and I can imagine it's very difficult being so tied down, not being able to do the things you love to do. One of which I know is play a lot of golf as well, but I guess you can't play much golf in a moon boot.
Not going to be a lot of golf now for a while.
So let's talk about that, Tom. You're known as Mr. Serenity, and that's a name that was, I think Jack Schwager gave it to you in the Market Wizards book, and it's kind of stuck. And everything I've watched, all of your interviews that I've seen of you, you do kind of exude serenity. It's lovely to watch. Uh, you strike me as someone who's got a very good balance between life and trading. You're still active, even though you say you're retired. You're still pretty active, managing your own capital, trading your own
Mhm.
capital, right? Which we'll get into.
Mhm.
But something that interested me, and a question I wanted to ask you up front is: you've been retired for over 20 years now, right?
Right.
And you're 72 years old, you said. So that means you retired very young in terms of a career in financial markets. Why did you choose to retire so young? Because I get the sense you were very successful. We know that you know what you're doing. You could have possibly gone on to make even more money and been even more successful. We look at the likes of the Jim Simons of the world and the Ray Dalios and some of these guys that have made, Stanley Druckenmiller, guys that have made gazillions, and just keep on doing it into old age. But you chose not to. You chose to get off that path. uh, why? What was the reason?
Quality of life. What you find when you're very comfortable in your own skin in life, you realize that there's a certain number out there where you reach there, you have a gorgeous house here in the valley that I'm in right now, and I've got another one, custom home up in the woods, same size, beautiful, probably about the same value, with a 26-mile view of the mountains. It's gorgeous.
Mm.
I have two great golf courses at both places. I have high-speed internet at both places. It's an hour, 40 minutes between the two. I drive a car that I absolutely love that is now getting to be about 5 years old, a Kia Sorento
Right.
SUV.
Yeah.
It fits my tall body. It's got all the automatic controls. It's got great sound. I'll drive that till it dies. Now, some
Right.
people are into the Lamborghinis and fancy watches and all that stuff. This is a watch I purchased over the web
Mm.
that's made for aviators. Why? Got a big screen so I can see it with my bad eyes. I can easily, because pilots are always going into different time zones, it
Mm.
has a very easy adjustment mechanism for time zones. So I can be on the flight and say, okay, I'm in Montreal. I need to be in Phoenix, and so that's going to be 3 hours. Boom, boom, boom. Hit it, lock it. I'm ready to go for Phoenix.
Right.
So it like a couple $100.
Yeah. And
I
it
broke it
tells the time
out
like any
working. I
watch.
bought another one. So I guess what I'm saying with all this is if you're into the status, into the bigger house, you know, the garage with 20 cars in it and a watch collection and who knows what, a wife collection in some cases, it
Yeah.
seems.
Yeah.
I'm not that guy. I'm a chemical engineer that's made a lot more money than most chemical engineers would normally make. I've had a successful run in money management. And the reason I really decided to move on to retirement was that there was a lot of different reasons. One of them was the largest part of our 600 million was in currencies, and we
Mm.
were trading 30 different currency pairs.
Right.
And there was about $40 billion in 2000 went out of the currency trading business when allocators were looking at the euro coming in and your 30 pairs went down to about 14.
Mm.
And they were, the people giving me the money were saying, I don't know how that's going to work. So until we know, we're just going to kind of back off of currency trading. So we're happy with you, Tom, but we're not going to give you allocate any more money. So 40 billion, I mean, we were 600 million. We were a good size currency trader. There was a whole bunch of other people that even lost more
Yeah.
and other people lost less. And but 40 billion in 1 year went out in 1999, I believe. It's either 98 or 99. I can't remember the year. But from that point on, then we were down into the 100 million area, which, to run a money management firm at 100 million with a staff and computers and regulations and audit fees and legal fees for prospectuses and all this stuff, you're really not making a lot of money.
Yeah.
So that's not going to be a motivation. You have a liability. Some client in a wacko move could say, I'm going to sue Tom because he lost money on that trade, or I didn't like the way he did this. And they can sue you. You're a registered investment advisor, so you got a legal liability there.
Mm.
And I was getting a deeper and deeper pocket. So I'm more and more of a target for legal liability.
Yeah.
So I thought, all right, well, if I retired, I wouldn't have that anymore. And then there was the other factor is the markets are pretty unmerciful in terms of they open at the same time every day, they close at the same time every day. They don't really care whether you're having internet problems or power problems, electricity or anything else, or your
Yeah.
computer died this morning. The markets are pretty unmerciful. So when you're running a business managing other people's monies and there's liability involved, you have to have plan B, plan C, backup facilities. There's a lot that goes into, we actually once a year would run disaster drills and make believe that our main office was completely destroyed
Yeah.
for whatever reason, fire in the building, whatever,
Yeah.
it's gone.
Yeah.
So we had to operate from offsite, and we did that each year as an exercise. And every time we did it, we learned so much that we didn't have right and
Yeah.
that we had to scramble to get through. So I took it very seriously, and it kept me from being able to do other things that I thought would be fun to do. Uh, didn't have as much time to work in the gardens like I do now. I didn't have as much time to take dance lessons, which is where I met Brenda
Right.
at dance lessons, Arizona two-step dance lessons. And just a lot of things in life. And you start realizing then one other thing that came in right at the same time was Microsoft bought out Fox Pro, which was the language that all my computers, about $1 million I figured I spent on building TrendStat's computer systems that ran everything that we did. Very nice platform. Really loved it. But Microsoft came in and said, we got Visual Basic over here. We got Visual Fox Pro. We don't need both of those. Let's just not support Visual Fox Pro anymore.
Mm-hmm.
So now my entire platform is built on Visual Fox Pro and it's not going to be supported anymore.
Yeah.
And I face the prospect of probably at least $250,000 expenditure to get the existing platform over into the new software, which doesn't ensure that Microsoft won't make the same decision with Visual Basic.
Yeah.
And then
Yeah.
I'd be screwed again,
Mm.
or go completely away from that and redesign it all into some public software like Python or C# now is public domain,
Mm.
so that Microsoft would not have sway over whether or not I can operate my stuff going forward.
Yeah.
So basically, a lot of those things came together at the same time, and I thought, it's just logical. I could be doing so many more fun things.
Yeah. Yeah.
And so I took a year off of trading. I went to totally my whole net worth in money market funds, and I just I started doing dance lessons. I started doing cooking lessons. I'm an accomplished chef. I do charity dinners now for some local charities, multi-course Italian dinners paired
Yeah.
with wine.
Yeah.
I have a blast. And so life's a lot more fun. I basically retired, put a smile on my face, and it's been there ever since. So
Yeah.
that's kind of the reason. It just was time.
What a
And I don't
pleasure.
really, I have more than enough money to create this wonderful lifestyle I have. I don't, if you gave me another $1 million today, it would just go in the account. I just trade a bigger number and I'd do the same thing, live in the
Yeah.
same house, live in the same car,
Yeah.
have the same gardens. I love my life the way it is. I
There
don't
was a
want to
there was
change
a
it.
word that you said there, which is enough. And I guess that's the key, right? It's knowing when is enough or what's enough, how much is enough.
Some people don't. They're
Yeah.
obsessed with, there's some people that start out in life just almost starving to death. Their parents are in a bad situation or whatever, and they vow to themselves, I'm never gonna, be in that situation. And they're obsessed that things could go wrong. So the bigger the number, the more cushion they have to that falling back into poverty level. And they just keep obsessing about making more and having, more
Yeah.
fancy jewelry and
Yeah.
whatever.
Yeah.
This and that. I need 6 homes in different locations around the world. I mean, 2 homes are more than enough hassle for me to deal with. I don't want a third one, let alone 6 or 7. And I
Mm.
don't really. I only drive one car, and I love it. And I'll drive it till it dies, and then I'll buy another
Yeah.
nice car that fits me as a human being, in terms of
Yeah.
my height.
Yeah. Yeah.
I don't get the obsession with just trying to create an infinite amount of wealth. I think creating enough to sustain yourself for many, many years going
Mm.
makes a lot of sense. But when you reach that number and you're a good trader and you realize you can just kind of keep multiplying the existing portfolio so that it's not really too stressful to think about what's going to happen in 10 years if I live that long,
Yeah.
then you're at peace and you're where you should be, and you just don't want the hassle of more things or more activities to do. I mean, sitting here at my desk talking to you is fun.
Yeah.
This is not hard duty. You're going to ask me questions about my life. Well, I lived my life. I didn't have to study for this
Yeah.
interview, right?
Yeah.
And so it's just fun talking to people around the world. I've got friends in all sorts of different countries now. We got the website with a lot of good information on it for traders. I get emails from people all the time. I went to Portugal, and one of the guys that follows me on LinkedIn heard that I was going to be in town. We ended up having the most delightful lunch one day. I just had a slot in my schedule, and
Yeah.
we hooked up, and it was perfect. And we were out right by the river there in Lisbon, and in an outdoor cafe. Wonderful food. He knew what to order and took
Yeah.
care of it all. It was great, and it was
Fantastic.
2 blocks from my hotel. No big
Amazing.
deal.
Amazing. That's
So
awesome.
it's a lot of fun being me.
Yeah, so I'd like it. Sure does. It sure does. But now you're retired and obviously you're going about enjoying the ride. And I love that you've got a t-shirt on which says ETR, enjoy the ride.
ETR.
I know that's your brand and your website, enjoytheride.world. And I've been on it and I've had a look. It's yeah, about life, right? It's about doing the things that you enjoy. It's about exactly that, about enjoying the ride. However, you're still active in the markets. You're still managing your own portfolio. And when I say active, I mean, from what I understand, you're doing it daily. You're checking it daily. I've just listened to your book, your all-weather trader book on
Mhm.
Audible. Very good. I
Mhm.
might actually buy the hard copy as well because in the Audible they reference quite a lot of diagrams and things, which obviously you can't see
Yeah.
while you're listening. So I kind of had to visualize, but I followed it and enjoyed it very much listening to your book. But yeah, and I've watched you on other podcasts as well. A recent Trader Lion podcast that I followed with Richard said you mentioned there that you're following 62 markets and you've got 9 different trading strategies. That's a lot for a guy who's retired.
Yeah,
Uh,
well, some of it's automated, and I
mm,
pared down 2 of them so that now they have 7 strategies.
okay.
I combined exposures in a way to make my life just a little bit easier. And I've got the last strategy is going on SimTrader, this platform I've been consulting on for pushing 5 years now. I'm the alpha tester, so I'm using it on 6 of my strategies. The seventh is maybe coming on after we get off today.
Right.
We're going to be doing some testing and see if I can make it work. If it's working, then I've got all 7 strategies automated. I'll be down to 15 to 20 minutes a day. That's not too burdensome.
No, it's not. That was exactly going to be my next question is how much time do you spend watching the market and how much time does it actually spend? How much of the time do you actually spend placing trades? Because,
Well, I
I think a
usually
lot of,
get up.
yeah,
I usually get up somewhere in the 6 o'clock in the morning range. 6:30 is the start of the markets here in my time zone in the summer. And
okay,
in the winter, coming up in November here, we'll switch. The rest of the country goes to standard time off of daylight savings. And Phoenix and Arizona stays on standard time. So we go
okay,
mountain time now.
right.
So we would actually be 1 hour earlier to London than we are right now. And what I usually do is get up and usually have a cup of coffee in bed, typical retired guy. I get my iPad, just check and see what the markets and the portfolios are doing, and look at some of the financial news, what's breaking overnight, and see if there's anything significant out there that I might want to be curious about. It doesn't affect my trading too awfully much, but it just emotional attachment to world events and trying to understand the world I live in. And then I'll wander into the office here where we are right now. I don't know, 7:30-ish. Hour, half an hour to an hour after the market opens, so that I've got a lot of my overnight and my market open positions have adjusted, and I will then check against everything that I do for record keeping to make sure that everything was executed flawlessly like I expected it to, get everything ready to go. And then round about 3 o'clock, 2:30 to 3 o'clock area, 2:30 to 3:30 roughly right now, if I can make it 2:30 to 3 down the road, if I can automate this last section. There, I'm just taking what I've figured out was executed today, making sure my positions are all in the computer, what they really are at my broker, and then I hit the button saying run.
Okay.
It runs, generates a set of orders according to algorithms that I've put in there and tested and simulated and approved and everything. Each one's designed for a completely different purpose, different time periods, different markets, different methodologies that trigger the buy and sells. So they're very diversifying.
Right.
In some cases, they fight each other. If you looked at my positions right now, I have about maybe 36 futures markets. And out of the 36 futures markets, there's some techniques that are potentially going to counterbalance each other. They're
Right.
actually sometimes one might go short when the other one goes long, and they offset each other. And you end up with net zero positions in that
Okay.
market. So each strategy might be long and another one might be short, but I'm net out of the market,
Right.
which means I have zero risk on that market.
Right.
And so when you have those situations, you see that your risk levels are going up and down, and it allows you to maintain tight control over all your risks. And that leads to Serenity itself. And that's pretty much it. I'm done for the day. I close down the computer and I go out and hit golf balls or play 9 holes or go out in the backyard and prune some bushes or go to the grocery store or go pick up the mail up at the mailbox,
Yeah. Yeah.
whatever I feel like doing.
So you've set it up to be this way where it's all automated. I mean, obviously a lot of hard
Every
work and hours have gone into the background, but uh,
hours and hours of thought and work have gone into making all of this my normal day.
yeah. And I mean, I'm guessing that I mean, and maybe you can correct me if I'm wrong, but I mean, do you have a lot of leverage on, because you do mention that you've got a series of offsetting positions, some long, some short, at different futures markets. Uh, is there a lot of leverage either way, long or short, when you're
My average position in one strategy
Yeah.
careful qualifier there,
Yeah.
would be no more than a half of 1% of my equity in terms of the risk I'm taking on. So
Right.
from where I'm getting in to where my stop loss is, that's
Yeah.
the equivalent in any one market, one position
Okay.
of half of 1% of equity.
Right.
Now, what can happen, which is always interesting, is you get into something like a COVID move where markets are all crashing. So I've got maybe a shorter term strategy that's gone short quickly. And then a long-term strategy kicks in short.
Yeah.
And some other strategy that's trading counter trend got an overbought condition before the spill and it went short. And now the leverage in any one market could be a combination of three things, each of which might be a half of 1%, but all leaning the same way.
Right.
So there could be some leverage at some times, but even when that's occurring, other markets could be offsetting each other and having zero
Yeah.
exposure.
Yeah.
So I'm never anywhere near margin calls. And, if I have a really, really knock your socks off day, it could be 2%. That would be an unbelievable day
In terms of gain,
to the good side.
a gain of
And to the bad
2%. Yeah.
side, oh, I'll have some days that could be down 0.8, 1.0, stuff
Right.
like that.
Yeah. Yeah.
So some traders that might seem like a lot, but I've been doing this 50
Mm.
years, so
Yeah. Yeah.
I've seen both sides of it. It's no big deal to me.
Yeah. So what is a good year in your eyes? Because keep in mind, a lot of listeners to this podcast are sort of DIY traders, retail traders. They've got
Right.
nowhere near the level of experience that you have, but also nowhere near the level of money and funds that you do. Um, and I think it would often surprise people to know that an expert such as yourself, often the annualized returns are not, they're not like shoot the lights out numbers, but if you just get them, if you generate reasonable, high single digit or low double digit returns consistently year in and year out, then you actually make a lot of money over time. So in your world, what is a good year? And I know it's an open-ended question because it can vary,
Yeah.
it can
I'm going
be,
to give you a weird answer.
yeah.
Uh, it depends on what the markets will give the trader.
Mm.
For instance, a good example was COVID. It was the best year of my life trading. Why? Because we went into the COVID crash. I was short everything. Everybody out there on Twitter, I'm seeing all these things. Well, it's not ready to go up yet. They got the vaccine, everybody's getting vaccinated. We're going to save the world now, and nobody's, we're not going to all die. There was this panic out there that was way, way overblown.
Mm.
In the strange sense of things, if you look at the flu statistics, we had no flu in 2020, but we had a lot of COVID.
Yeah.
So I'm suspicious that, there was a replacement in the data there if you study the CDC data in the
Mm.
US. But forget the conversation on COVID. That's another whole hour talk. Um, what I then saw is everybody saying, okay, this thing's crashing. The only way we could go back up is we got to test the bottom, and we haven't tested the bottom. So in comes the vaccine, the market gets hopeful, it starts running up. Guess what? V bottom, no W.
Yeah.
My indicators went over to the upside. The longer term ones kicked in. So the short term went first. They oversold. Counter trends kicked in. The short term trend following kicks in. The long term trend following kicks in. I am fully loaded to the upside. I make a killing to the upside. I got 103% return that year.
Wow. So you caught it on the way down
Now,
and on the way up.
I'm doing the same thing roughly now as I was then.
Mm.
But this year has been a bit more trying to top, had a little downswing, had a little bit up to new highs, but not really robust new highs, just sort of eking along new highs, kind of trying to feel its way a little bit. And so I think I'm at 12%, nowhere
Wow.
near the 103. I
Yeah.
would not expect to ever see 103 again. I hope the world doesn't have to go through
Yeah.
what would be required for me to make 103% return.
Mm.
So yeah, 12 is more than enough for a retired guy. Inflation's running 4%, maybe something like that. That's giving me a little extra capital build up so that over the long run, I can pay my taxes. I can get inflation increases in my
Yeah.
ability to pay for my lifestyle. Um, I think it depends on what the market gives you. And
Mm.
I think a good year in trading to me is to assess what kind of markets you had and had to trade and how well your trading strategies matched up and exploited those conditions.
Yeah.
That'll tell you more of the answer than will be one kind of number like 15% or
Mm.
12 or 20 or
Yeah.
and maximum drawdowns to a certain extent the same answer to that question
Mm.
in that you depending on what kind of strategies you use, market action will lend itself to creating drawdowns. And they're part of trading. You can't avoid them.
Mm.
But you can add strategies together to say, okay, well, this long-term strategy is definitely going to have a drawdown when these things happen. But when that's happening, this counter trend strategy could kick in and offset some of that
Mm.
and minimize that drawdown a little bit so that it's not hurting you so badly.
Right.
So that's kind of the answer on that as well.
Mm.
So it's
Mm.
more like, how can you, if you can look at what the market provides and then exploit it and avoid the negative risk, attack the positive risk, attack the negative risk, and
Yeah.
and get that balance right, that's what constitutes a good year of trading.
Mm. Mm. Okay. Okay. Um, Everything that you've said, Tom, so far is all around systematic trading. So, and the question I've got for you is: do you ever apply discretion to your trades, or is it all completely systems driven? You just listen to what the system's telling you and obey
Where the
it.
discretion comes from is discretion comes into play when you're designing your algo or your system or whatever you want to call it. The if you are trying to do something to a certain market condition or a certain market, you ask yourself the question, all right, if I'm sitting here at the screen doing this and wanting to, I don't know, have a head and shoulders pattern and short it, whatever your system wants to be,
Mm.
you have to ask yourself, all right, if that is going to work over the long run and I'm going to algorithmize it, how do I describe that mathematically to the computer so that they're simulating what you would do as a discretionary trader?
Right.
And then you pour your money and your time and your efforts into building that which will read that price data and actually simulate Tom being a discretionary trader.
Right.
And that's where all the discretion comes in. And then once you've got it wired, tested, functioning, data coming in reliably, all of those good things, then you run it. You don't
Okay.
need discretion
Yeah.
because your discretion's built into the strategy.
Yeah. Okay.
No,
Okay.
I don't have to do anything.
So you don't have to, you don't allow your emotions to ever get involved or to be part of the decision making process.
No,
Hence the Mr. Serenity name. If you're on top of those emotions, which can be such a problem in trading sometimes. Uh,
definitely.
you've obviously got a lot of statistics and a lot of data on your trading because it's very systemized, as you've said. Are you able to share with me the over a long period of time what the average win rate on trades is? How many
Yeah,
trades do
over
you
my
win?
lifetime, I'm running about 33, 34% reliable.
Okay.
So I do roughly, if you think about it, round the numbers, two losing trades for every one winning trade.
That's amazing. So that's even lower than I was expecting you to say. I thought you were going to come in somewhere around 50-50. So that's amazing. So a third of your trades are successful and
And
two
they are
thirds
very
are, but
successful. I
right.
let my gains run.
Yeah.
And there's sometimes like orange juice now looks like a F-35 going with the afterburners on
Yeah.
because of hurricanes going through Florida.
Yeah.
Last year it was cocoa, I think it
Yep.
was, and
Yep. Coco went
whatever.
banana, went crazy. Yeah.
I never know where it's going to come from. Oil just yesterday was down $3.50 a barrel. Last I looked,
Mm.
you get big moves in lots of unrelated weird markets, and I trade as many as I can.
Yeah.
That's a function of how much money do you have in the portfolios, how much
Yeah.
time do you have to deal with it,
Yeah.
how much data can you get? Because if I'm trading Singapore iron ore, I got to be able to get SCI data from someplace and suck it into my computers and then generate my orders to ship back to the broker to
Mm.
put them into the Singapore market. So there's there's just little stupid issues involved with a lot of this stuff that you just have to kind of work through. And sometimes it takes time.
Yeah. Yeah.
Before I could add in SCI to my portfolio, the iron ore, it took a few days of making phone calls and inquiries by email. And
Right.
there's just a lot of people involved. You got the data providers, you got the people running the platform that I'm using to run the simulations. Everybody's got to be on board and have SCI in there for me. So um, you just kind of, I think what you're trying to get to is not having to say, wow, there's this neat little, I don't know, a trade in rapeseed in Canada or
Mm.
canola, it's also called. I think I'll go short rapeseed. Like I don't ever do that.
Yeah. Yeah.
If I want to trade rapeseed, I've got an indicator that's geared to doing that, and I've got it all automated. And I
Yeah.
may come up with the idea. I may look at rapeseed and say, "Oh, that's an interesting market. I should be trading it."
Yeah.
And then I'll go ahead and start the process, research data. Can I get that into my system? So that's kind of the flow.
So some of the what you've said has got me thinking. I mean, you've talked about rapeseed, you've talked about orange juice, you've talked about cocoa, you talked about iron ore. These are all commodities, and you also
Mhm.
mentioned that you follow futures markets. Are you typically just trading commodities futures, or do you would you look at individual stocks, for example?
It's evolved over time. The first thing I decided when I retired back in 2003 was that I didn't want to trade at all. So I spent a year in money markets. And
Right.
then I finally got married to Brenda, and she comes to me one day and says, you know, you're this market wizards. I guess you should manage our portfolios after we get married. And so I said, "Oh, okay, I got to get back into the trading business." And I have a client, but at least she's a wife, not somebody who's going to sue me. And so I geared it all up again, and I decided to do stocks. And I was running that for a while, and then I realized that the amount of time for me to screen the stocks that I needed and to manage the what I would call event risk, the earnings risk, or the manufacturing plant burns down overnight or is in the middle of a war zone or whatever.
Yeah.
Uh, you get these jumps that were starting to get concerning, like, 5% on the open, you're up or down either. You're either
Yeah.
making a bunch or you're losing a bunch.
Yeah.
Shorting it became a little awkward because you got to get there was the uptick rule back then. And
Mm.
I, I started thinking, this is a lot of work and I'm supposed to be retired. So I spread that risk by using ETFs, which is a security.
Right.
But what I found when did that was that I in US tax law, there's this thing called wash sale rules. All right.
Okay.
So if you're going long term, and I was pretty long term, I was getting in on a 21-day indicator set and I was getting out on a 50-day indicator set. So a lot of my trades would get over a year long, no problem, into
Mm.
long-term gain status. But some trades I would be cutting my losses short. The indicator would say, get out, it's going down. So I've got a ticker and I've gone long, I've gotten out, but now the indicator tells me to get back in. And if it's under like 45 days, I think it is,
Yeah.
it's a wash sale. And you don't get credit for the loss that you took,
Um,
which is not particularly helpful in the taxes.
yeah.
So it turns out all futures contracts from a US tax code, and this is my issue. This is not UK, this is not India,
Mm.
where I was just giving a talk to half an hour ago. Different tax laws, different countries, different instruments you can and cannot trade, different directions you can to participate in. You have to create your own trading strategy to deal with your own financial puzzle, not mine. But in my case, to get rid of the WAS sales, I said, that's equity exposure to the upside going to cash. So globally speaking, I could get that by moving some equity exposure into this strategy over here and adding some index futures contracts to that. And then I've got my upside downside equity exposure even enhanced. And I don't have to waste capital over here. And it makes my capital utilization and my capital exposure more efficient. So currently, I have got 2 ETFs left in my old sector timing that was mentioned in the All Weather Trading book.
Yeah.
And when those 2 are gone, I'll probably not be trading that over the short run.
Okay.
It's always subject to change depending on tax law and my mood and what I think long term we need to do. But the the bottom line you got there is you you create exposures and you create utilization of capital. And what I'm trying to do is to take all these 7 strategies and most efficiently use that capital to diversify myself over time periods, over markets, over different directions, up and down, and over different strategies. So the different indicators and everything. So, any one day, one strategy is making money, the other one's losing. As long as I can get, it's interesting because I just said that I was about 33%, 34% reliable over a long period of time, over my lifetime. If I measure the days profitable versus the days negative, though, I'm 52% of my days over the last 12 months profitable.
Profitable, really? Okay.
So any one strategy might be 40% if it's a short-term strategy, 30% if it's a very long-term strategy. It all averages out to maybe 33, 34, something like that. Definitely less than 50.
Right.
And then what you do is you just keep running it, and you're building the expectation on each trade is positive, but you don't know that that trade's going to be a positive trade.
Yeah.
It's 2/3 of the time going to be a loser probably. So you manage your risk, and your goal is to do your next 1,000 trades and make that expectation come into reality.
Yeah.
Any one trade is just one little data point in a massive database.
Yeah. One piece of a big puzzle. You talked about risk there, and I want to just ask you about this because something I found very interesting listening to your book was that you reference not just stop losses and position sizing based entirely on a on a dollar value or something, but you also look at volatility adjusted position sizing, which I found very interesting because obviously a more volatile product, I suppose you put a smaller position on, and a less volatile position you put a bigger position on. I found that really interesting. Can you talk to me a bit about that?
Yeah, the goal is to always keep your position sizes from intruding on your mental process. You'll find whenever somebody says, oh my God, my portfolio went up or down 5% today, if I just do simple inquiries, it immediately is obvious that they're trading too big.
Yeah.
They have too little capital and too big of a position for that capital. And volatility has a way of, let's say you have a 10% day, thanks to some windfall in one of your positions.
Yeah.
It could be a stock that just opened up 20% for the morning and you just killed it. All right. So you had a great day. That positive volatility tends to hit your brain and say, hey, dear, we made a lot of money tonight or today. Let's go out and have steak dinner tonight.
Yeah.
And celebrate. Well, of course, tomorrow you could be down 20 in a position.
Yeah.
And then you're going, oh my God, I just feel like I got hit by Michael Tyson on the side of the face.
Yeah.
And so volatility is not risk in the sense of losing money, but it's risk in the sense of intruding on your mental peace of mind, if you want to think of it that way.
Yeah.
Now, guys like Jerry Parker and others, And I totally agree with what they say, that pure trend following is going after the highest returns. And if you volatility adjust your positions, you are going to diminish your returns. I would argue that's not what my goal is. My goal is the highest return to risk. That's
Yeah.
different from what they're talking about. If I can reduce that risk to smaller amounts, my mental side is smooth as could be. My return side is slightly less as well, but the ratio of return to risk,
Mm,
the denominator has a lot of effect, return to risk.
mm,
There's a line in between.
yeah.
If you're just focusing on return, then you don't need to volatility adjust anything and just hang on for dear life. And you're going to have a wild ride and do your best to enjoy it, but it's going to be a wild ride. I
Yeah.
don't prefer to have a wild ride, so
Yeah.
I smooth it out using the volatility controls.
Mr. Serenity. There we go. Um, Something I also loved in your book was where you talk about filling in the potholes, and it's a
Yeah.
terminology I'd not heard of before, but it makes so much sense when one
Lawrence,
thinks, yeah,
I have to credit Lawrence Bensdorf for that one.
okay,
He's a trader over in Portugal that I went to see.
yeah,
He's the one that came up with that idea, and it's so perfect.
it
You
really
got the
is.
track record going up the page, a straight line, but in reality, there's these stupid potholes that come along called
Yeah,
drawdowns,
yeah,
and you have to ask yourself when you're in a drawdown, what is creating this drawdown? The mentality is, I don't want to have any drawdowns.
yeah,
No trader wants that.
yeah,
You'd like the straight line going up the page. Um, so what kind of price action are my current suite of strategies not picking up? What strategy could I be making money during this pothole?
yeah,
And I could add that to the suite and then make that pothole a little smaller.
yeah,
So that's what I call when you're designing a new strategy, you're looking at that pothole and saying, how can I make money during this pothole?
yeah.
And it could be a lot of different things you could come up with. I think I developed my credit spread. I just put some options on and I do a bull or bear spread
Yes,
and I pick up a few bucks. It's not going to make me rich, but it brings in money,
fills in the pothole.
helps offset some of the pothole.
Yeah,
Uh, those types of strategies, or you maybe start trading a 3-day strategy that is a really quick acting thing where it's going to try to trade during the sideways periods where you're in a big drawdown in the long-term trend following.
mm,
So you just try to develop logic that goes after it and exploits different types of market action so that when you marry them all together, you get closer to that straight line.
yeah. Very interesting. I want to just quickly talk about the use of option credit spreads here. And I'm always cautious with these podcasts not to get too into the nitty gritty of options because it can get lost on the audience to some extent because options can be complex. But you talk in a book about using credit spreads, and often it's a 1 week credit spread. Now, just for the benefit of the audience, we're talking here. A credit spread is often where you sell one option and buy an option further away from the money, and you
Correct.
try and lock in the difference between the two.
So
And
you have limited risk.
yeah, limited
It's
risk,
one
limited upside
transaction
as
once a
well.
week.
Yeah,
Once a week, I do a trade. It
yeah.
doesn't take, but what, 3 minutes? I
And
don't know.
the question I'm asking is there enough in it when you're that close to expiry? Well, I mean, there must be, right? Because you're doing it. But the type of credit spreads that I look at and having interviewed Tom Sosnoff, who I'm sure you know of, he
Mhm.
is the Tasty Trade guy, and they're big on credit spread structures, and we had a long conversation about that. But they've optimized it and said, well, the right time is 45 days to expiry because you get the maximum theta decay in the option at that point in time, and they've scientifically figured this out. You're doing it much closer to expiry. Um, I presume you just do it and then let them expire well, not
A lot of
worthless,
them
but you
do.
you collect the premium, right?
A lot of them do, and I
Yeah.
collect the premium.
Yeah. Okay. And you don't do further out like what Tom says, the 45 days. It's just
No,
not
7 or 8 days, depending on how the options line up with the calendar.
right. Right. Okay. And as you say, you don't make a lot of money doing that, but you make consistent money. They are quite high probability strategies. I mean, I would guess if you had to go and just look at that particular strategy on its own, your success rate must be significantly higher than the
Oh, yeah.
33%. It's probably,
In a sideways, the
yeah,
option spread strategy is probably 80%
yeah,
reliable.
yeah.
So
I would say so. Yeah,
massively reliable.
yeah,
But the expectation and the amount of money you're making is very small.
yeah. It's a lowish or pretty low risk, but yeah, hence low return as well.
Well, it's
Okay,
limited risk.
yeah,
So you still have to be careful and size your position properly. You don't want
yeah,
to do too much.
yeah,
You don't want to be full of it and say, wow, I'm 80% reliable. I think I'll do 3 times the amount on this one. No, you got to stay with the strategy, size it properly, get the right amount, and just accept your pennies.
yeah, yeah, yeah. In the discussion around drawdowns though, and filling in the potholes, I mean, you've obviously, you're a trader, you've done this for a long, long time. You must have experienced some nasty drawdowns. Even the best
Mm,
in the world do. Can you talk to us a little bit about that? The length of time of a drawdown, depth of a drawdown, uh, how quickly did you recover from it? Some of the bad times, because we all know that that happens to the best of us.
yeah, I'm trying to think of where I would have had some of the biggest drawdowns. They would have been back during TrendStat someplace along the way, and it would be within a single strategy, not across all of them, and which is the way we eventually ended up with a multi-strategy approach so that things were kind of being buried together and much more similar to what I'm doing today with my own portfolio. Um, it's probably more like a year to 2 years. It was probably in the 20% range to 25. And I knew I was coming back from it because you could just look at the equity curve and you could
Mm.
see the risk levels go way down. All my positions were getting larger
Yeah.
for the amount of dollars because the risk stop loss points were getting tighter.
Mm.
So you just trade it, and then all of a sudden you get something bursting, it goes crazy, and you're quickly right out of the drawdown again.
Yeah.
And
Yeah.
nowadays I'm trading so many different markets, so many different strategies, stuff that I mean, a good example, I trade, say, the Ether micro Ether contract.
Right.
So it's the futures on the crypto,
Yeah.
and it's on the CME,
Hmm.
big exchange.
Yeah.
The futures contract is backed by the exchange. So I've got the financial stability of the exchange
Mm.
standing behind it, and I don't have to worry about an FTX
Yeah.
scamming me or whatever,
Yeah.
and I can go long and short with equal ease.
Yeah.
I have no wash sale rules. So you end up, that fits my situation nicely. And I go ahead and I do that. If I had added a crypto trading futures strategy to my suite of strategies for the typical like Merrill Lynch of the world that had hired me to do my world currency program for $100 million,
Yeah.
they would just fire me immediately.
Yeah.
I'd say, no, this is going to actually help you.
Yeah.
I don't care.
Yeah.
You told us you were going to do these 30 markets and trade your world currency program.
Yeah.
And now you're introducing this currency called crypto. We don't believe that's the case. And we think it's garbage, and you're not sticking to your strategy. So you have strategy drift. We don't allow that. You're fired.
Yeah. Yeah.
So as a manager, you're really, really tied in. From an individual, I can look at it and say, those markets are going up and down a lot. Movement is profit.
Mm.
Movement is risk, both positive and negative. If I can attack the negative risk and exploit the positive,
Mm.
that's going to help the portfolio. I'm going to do some research on it. I start it up, I put it in. I don't even tell Brenda that we're doing it. It's just part of the strategy now.
Yeah.
And so you can do a lot of things as an individual trader that institutions cannot even dream of.
Yeah. Yeah.
So
In
it's a
in
lot more
in
fun.
your book, just to that point, there was a few little snippets in the book that I got the feeling that you found dealing with clients challenging,
Yeah,
demanding.
yeah.
And I mean, I know I've done it a little bit myself, not to that extent like you did,
I
but
didn't
but
smile as much back in those days, according to my friends.
is that you gave a bunch of reasons earlier in the recording why you left the industry and why you retired. But I mean, uh, did that also play into it? Just the fact that clients can be very difficult, very challenging.
Oh yeah.
It's
Oh
hard to
yeah,
manage
sure. That
their
was part of it
expectations.
too. I mean, here I was making very little money off of running 100 million, and
Yeah.
I still have to put up with the same client question from the guy that asked me the same question a year ago.
Yeah.
And I give him the same answer this year as I did last year. And I'm expecting a call from him a year from now.
Yeah.
And you just hey, it's their right. They're paying me good money to manage their money. I'm the hired gun to go
Mm,
after the markets.
mm,
If they could do it themselves, they would. They
yeah.
can't.
Yeah.
They think they want to manage you, but if they knew what they were doing, then they would manage you appropriately. But if they ask you insane questions that have nothing to do with making profits in trading, then you're kind of trying to be polite, but tell them, you really don't know what you're talking about. You have to look at this. And I did a lot of research back in the days that's on the website
Yeah.
on all sorts of strange topics, just so I could pull out a research paper and answer somebody's questions. Oh, that's a good question. We actually ran a study of that over 40 years, and here's the index, and here's the amount of time that happened, and here's the reliability of that. And then all of a sudden, the eyes glaze over in the client and say, "No, I guess he knows what he's doing."
Yeah. Yeah.
Yeah, it got old. It's not very productive. It's not allowing me to go make them more money by researching and developing new strategies that
Yeah.
would do well for them.
Yeah.
I'm still stuck in what they want me to do from 5, 6 years ago, and they won't let me do anything but that.
Yeah.
So it's very restricting. And
Yeah.
I mean, part of the reason I have a smile on my face is I can do pretty much whatever you want. And back in the day, I just used the example of, say, orange juice.
Yeah.
I don't even think I might have traded orange juice, but it was immaterial.
Yeah. Yeah.
Well, today it's not immaterial anymore because an individual can dance in and out of a lot of markets, and they're not going to trigger, the market going limit direction up or down. But when you're trading $600 million and you start jumping into a small obscure market, you're going to move it.
Yeah.
And now you got to start coming up with a trading desk that moves the position over 3 days. And, you do a little bit every hour, and you try to be secretive and maybe use a few different trading desks and don't let anybody know what's going on. And oh, it's just a mess and a lot of work. And so life's easier. I can just go, yeah, hey, let's do 10 orange juice right now.
Yeah.
It's ding, beeps at me, and there it is. It's
Just
so
done.
easy.
Yeah.
And it's I think individual traders, most of whom are watching this type of a podcast,
Yeah.
have a huge advantage over institutions if they're smart about it.
Yeah.
Everybody says, well, how can we beat them? They have AI, they have all these, knowledgeable people. Let me tell you, some of the most knowledgeable allocators that I ever had that could run circles around me talking statistics
Mm,
made the dumbest street smart decisions out there. They would take money out at the bottom of the drawdown. They'd give me money at the top of a surge, making new highs. Oh, Tom's really hot now. Let's allocate more to him.
mm,
That's right before we go through the next drawdown.
mm.
And then they fire you.
Yeah.
I had an example that just drove it home. Stock portfolio for an insurance company down in Tampa Bay, Florida.
Mm,
They gave us $100,000 way back when. We got lucky with a couple of takeover candidates. We ended up making a 50% is that right? No. Yeah, it was like let's see, 100,000 went to that. I think we ended up making all totaled something like a 50% return, if I remember right.
right.
Story. We go to the board meeting. They say, "Well, you guys are doing exceptionally great. Here's another 100,000." So
Yeah.
now we got 250,000. We lose 20% on the 250,000.
Mm,
So we're back to 200,000. So we've gone up 50%, gone back 20,
mm.
still ahead on our numbers 30%, right?
Yeah. Yeah. Yeah.
Time weighted return. They fire us. 2 years, you made us no money.
Yeah.
I said, well, we did. We made 30% for you. What are you talking about?
Yeah.
Said, oh, we gave you 100,000 and another 100,000. You gave us back 200,000. I said, well, you didn't give us the second 200,000 for the same period that you gave us the first. They don't
You
come
know,
out equal in the world. This was a board of directors of a very successful insurance company that had no idea what they were doing.
yeah.
And that's an example that just sort of as a money manager, you on the flight on the way back in those days, St. Louis is where we were located. I'm thinking to myself, wow, this is a crazy business. I mean, people making decisions with millions of dollars are have no idea what they're doing. It's
Yeah.
crazy.
Yeah. Nuts.
But then, I finally got to the point where I said, I don't need this anymore. I don't have to put up with this insanity. So,
Yeah. And here you are now, retired. Last question, Tom, before we sign off is, a lot of people listening to this will be retail DIY traders,
mhm.
starry-eyed people wanting to make a go of it. And I know this is a difficult question because we've got limited time, but, one or two pieces of advice you would give to them wanting to start out getting involved in the markets. Uh, and I know to say one or two pieces of advice is extremely limiting, but if you could, what would you say to a
Well,
youngster starting out?
first thing you have to realize is that your mental process that you have towards trading is going to override every other thing you do. Your position sizing, your decision to buy or sell, what I call the buy sell engine, which is usually driven off of an indicator of some sort or a chart pattern or whatever. All of that is going to be ultimately overridden and managed by your mental process. So I'd really work hard on things like awareness,
Mm,
self-confidence, self-esteem, those types of things. I have done a good job over time of having high self-esteem, high self-confidence. I've disassociated myself from what I'm doing to a certain extent using observer self and trying to get into my mind, my own mind.
right.
By doing that, it allows me to be a lot more calm and collected about what's going on. And I think that leads to repeatability. Discipline is easier. Running your strategy every day is easier. You're not so emotionally up and down and into cortisol and
Yeah.
adrenaline and everything else that goes on inside your body. So
Yeah.
I think you can get more longevity. I mean, I'm doing this 50 years. There's people that were in the first Market Wizard books that weren't even trading anymore 10 years later. They'd
Yeah.
either blown up or they were so stressed out they just quit. That's not my thing. I just want to keep doing what I'm doing and make it easy.
Yeah.
So that's the first thing I would give advice to new traders. Work on your mental processes a lot and don't underestimate how important it is. And you'll get a jump on your career.
Fantastic.
Second thing is to realize, and a lot of new traders don't realize this. I get a lot of questions about, I want to become a CTA and I want to trade other people's monies and then, become a, multimillionaire. And that's what you did. Well, what I did back in 1970s is very, very different. We didn't even have PCs back then. We didn't have cell phones that you could trade from, and
Yeah.
you didn't have as much jet air traffic around the world and instant communications with the internet. Uh, so you got a different world today, and it requires a very different set of skills to be successful as a CTA. I don't think you can start as an individual like I was
Mm,
as a CTA, basically out of your garage, if you want to look at it that way. It wasn't out of my garage, but I mean, it's out of my office, but in my house, just kind of creating a track record and getting on people's radar screens and saying, hey, this Tom guy seems to have his head screwed on straight. He's making some money. Maybe we ought to look at allocating some money to him. And once you get to certain levels, then other people start looking at you. So maybe back in my day, if you got to 10 million, then somebody could give you 5 million.
mm,
You'd
mm.
be at 15. And by the time you got to 2025, other people are looking at you and they can give you, 25 million.
Yeah.
And pretty soon you're trading 600 million. And not that easy today.
No.
Nowadays, You need to go in with the thought of it's a business. I need 3 to 5 employees, backups. I need compliance being addressed. I need a legal budget. I need working capital. I need an office that looks suitable, that can receive due diligence officers. It's a serious starting of a business. And even then, you're not guaranteed success. If your track record sucks, you
Yeah.
go nowhere. You market the hell out of it and you get nothing.
Yeah.
It is a very difficult business to get into. On the other hand, trading individually has gotten almost a little easier because of the automation and the instant communications and the
Mm.
trading platforms. I mean, Interactive Brokers, I think, says that they have, is it 28 different offices around the world or some 23? It's some huge number.
Mm.
They're interconnected, all of them. And so you can get to any exchange, instantaneous, trade just about anything you want. And you didn't have that world back then. I mean, back when I first started, if you want to trade futures, you got to go through a futures broker. And if you want to trade stocks, you can go to like a Merrill Lynch or one of the stockbrokers. The two had nothing to do with each other.
Yeah. Yeah.
And then you're now wiring money back and forth to keep everything balanced. It was nightmare. Today, the individual has a lot more ability to do things that they didn't have the ability to do. And I still say that the liquidity for an individual is suitable in a lot of markets, a lot more
Yeah.
markets than the institutions can deal with. So
Yes.
I would seriously consider, as a new trader, trying to exploit markets that you almost know the institutions can't mess with,
Yeah.
and get some return streams going, get some experience under your belt, eventually start participating in more and more markets, more and more strategies, more and more time periods.
Right.
Automate it if you can, just to save yourself the menial effort.
Yeah.
Those would be two things I'd look at right away. If I were to come up with a third one, I would say that capital and your position size is far more important than you will think it is.
Mm.
Back when I started out, it was just sort of, oh, I'll just buy 100 shares of the stock. I didn't care.
Mm.
You start realizing that, oh, no, you got to balance this out better. So then I said, oh, I could balance this. I could do 900 shares of this stock that's this price and 100 shares of the stock that is trading 9 times the price of the first one, and it'll all balance out. Well, not quite, because the volatility of each of those positions is going a different speed. So there's always going to be certain numbers or certain tickers in your portfolio that have a bigger effect on your portfolio, and others that become a non-event. And why are you bothering?
Yeah.
So I'd encourage people to size their positions. I wrote a book on the topic. It costs all of $10
Mm.
to download it and get a PDF on it. Um, Everybody can afford it. I've downloaded thousands and thousands of copies of this book. Gives you the formula. You can put it in a spreadsheet, make your life easy, always get your position. And back in the day, we used to do 100 shares. If we did 99, it was an odd lot.
Mm.
And then we had to deal with the extra odd lot charge. Today, with the computers, you can do 57 shares.
Yeah.
Computers don't care.
Yeah. Yeah.
So it's so much easier to trade small amounts of money and do it efficiently and get your position sizing. It may seem very strange to a lot of people to be trading 2 shares of XYZ, but if that's the proper amount, given the way it acts in your portfolio,
Yeah.
you want XYZ and ABC and DEF and all of these other different tickers to all sort of equal each other. So you have a portfolio. You don't have XYZ and 9 other things that don't make a difference.
Mm. Mm.
That's
Mm.
not a good way to go.
Right.
So with small amounts of money, you can do that a lot easier now with computers and with the trading platforms.
Yeah.
Those are the three things that come to mind.
Yeah. Yeah. Fantastic, Tom. Those are brilliant. That's superb. I'm going to wrap it up there. We've had just over an hour. You've been incredibly generous with your time, and it's been an absolute honor and a privilege to speak to you. As I said, the first bona fide market wizard that we've had on this podcast.
It won't be the last.
I hope not. Yeah. Well, thank you, Tom Basso. Thank you so much for your time. It's really been a pleasure,
Yeah,
and go well. And I hope that leg of yours comes right very soon.
me too. Quicker the better.
Take care, Tom.
All right.
Cheers. Thanks for joining us for this week's episode of Talking with Traders, sponsored by IG, a world-leading CFD provider. We really are privileged to have such a strong global provider of online trading services as our backer for this podcast series. Remember to subscribe for more episodes by clicking on the subscribe button of your favorite podcast app, or if you're watching on YouTube, please subscribe to our YouTube channel, give us a thumbs up, and leave a comment. We welcome the engagement. Till next time.